Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, and Ben Kingsley, Chair of Property Investment Professionals of Australia, and the 2014 and 2015 Property Investment Advisor of the Year.
Alright folks, you're on the Property Couch, where each week we bring you the insider's guide to property investing. Chatting here with myself and Ben Kingsley. How are you, mate?
G'day, bud. How are you?
Very, very good. Mate, we get lots of questions come in, and we love this is the best part, isn't it?
It is because we're solving, hopefully we're trying to solve some of the puzzles for some of the people. Provide them with some solutions, or at least a direction on which to head to make further inquiry.
Perfect way to put it. And I guess this first one from Alex really taps into that some of these principles and these frameworks are actually applying to our community of listeners. So, hi, just looking for some advice. As the more I listen to the podcast and in brackets and read your book, the more I think my first investment property could be better.
Uh-huh.
We actually get that a bit, don't we?
We do. We actually get people contacting our business because they probably want to fix their bad portfolio up. With all due respect.
Yeah, with all due respect. So I'm currently on a de facto visa, so can't buy anything but new properties, which led me to an off-the-plan development in Fortitude Valley in Brisbane. While it's marketed very well and made out to be a great buy, it goes against all that you talk about. High-rise, buying through an unqualified salesman, no room to improve, rental guarantee, and high strata. At the time it looked good, but the more I understand what makes a good investment, the more I think I could do with the 40k deposit I put down. My question is there any way out of the contract that won't cost me? It's not due to be built for another 2 years, so wondering if I could ask the developer to renege on the contract without penalty or even on-sell it for cost price. I've started putting some cash away each week just in case it comes in undervalue, but would rather not be in the position of hoping this doesn't happen. Would appreciate any advice. Kind regards, Alex.
So, do you want to read through those things again? It's
high-rise, buying through an unqualified salesman, no room to improve, rental guarantee and high strata.
Okay, so this is all back to the fundamentals of scarcity, supply, demand. So what don't we have so for those new listeners to us, what don't we have? We have an oversupply risk, not only currently now, but into the future, because of the zoning around that area could result in more and more of those types of properties being built, and certainly in Fortitude Valley, that's what we are seeing. We've also got a disconnect between what the buying audience want to live in. So we don't have an audience around Australia who are saying, I want to live in a hotel room on the 13th floor of that hotel room. So that disconnect is really important to understand, and that's why we don't have owner-occupier appeal.
Yeah, so it's failing a few of those things. The high body corporate fee for me is the no owner-occupier appeal, because Nicola McDougall, who's part of the Australian Property Investor magazine, interviewed me yesterday for an article she's doing on 70s properties.
Yep.
And I said I'm really bullish on 70s properties because it's a bit like the picnic, the chocolate bar picnic. How it says deliciously ugly. I reckon they're just
like that.
reliably ugly. The old 70s apartments,
Yeah.
for example. And the reason I reckon they work so well is because the body corporate fees appeal to both markets.
Mm-hmm.
They appeal to the owner-occupier because they're usually about $1,500 a year,
Yep.
and they appeal to the investor.
Yep.
So that one there has high body corporates. It doesn't really appeal to either of those two markets.
Well, if you think about it, investing is about a return on investment. So if we don't have high demand, but we have high supply, there goes our capital growth story. So then we return to this story of, well, what about the income? At least I'll be able to rent it out and get a good income. Well, sometimes you're going to have an oversupply and high vacancy rates for that type of accommodation because not everyone's rushing into it. And so from that point of view, and even if you do get the rent, you're forever forking out costs to maintain the property. So, these high body corporates. So, yes. So we've got to answer your question, though.
Yeah, I was going to say, are we rubbing salt into the wound here?
Just look, because you've reached out to us and it's a really valid point, and this is why we're trying to fix these types of mistakes. So there is potentially something that they can look to do.
There is. And I guess his question is there any way out of the contract that won't cost me? Simply by asking and seeing if you can. Now, we don't propose, if we make commitments, we want to
if you've signed a
carry through on
contract,
them.
technically you may be in the gun for this purchase, but the reality is if your circumstances have changed, you could certainly approach them and simply ask, my circumstances have changed, is there a chance that this property can be, or this contract can be voided, rescinded? And if we do believe that would be highly unlikely,
Yes.
but you've got to ask the question. The second point that you could also look at is get a very sharp property specialist lawyer to have a look over the contract to make sure that the contract is watertight. Number 2. Number 3, if it is watertight, is and be very professional and pleasant about this, but you could go back to the sales agency and say, is anyone else looking for an opportunity? Because there may be an opportunity to buy my property. So you may get a sale on top of the existing sale there. So you're flipping it or you're moving it on, and that could be an alternative. So the probability of this happening is lowish, low, but they're the courses of action you need to take. And it's a warning to all of our listeners: don't sign anything until you've done good due diligence and asked professional people for an independent opinion. The sales agent's job is to talk it up. The marketing material is to show this amazing lifestyle, livability, and it's all done to the top end. Like, you cannot question the quality marketing that's done out there for these types of developments. Now, the other thing we'd also like to say, we haven't mentioned the development, we've mentioned the suburb. We don't know the development, so we're not saying automatically it's a dud, but generally speaking, you want to do some thorough research, because this might have uninterrupted views over the city that can never be built out. It could have scarcity value in other ways, and so it could turn out to be okay. But if it's your Legoland standard build, then in some cases there could be some headwinds in terms of investment returns.
Yeah, very, very good points there, Ben. So, for Alex, what I'll also say to you is I have bought brand new property in my portfolio in the early days. I don't do it anymore. So don't be discouraged if you do proceed, because I think that, if you keep your eye on the bigger prize, and that's to buy a portfolio of properties over time, that's will serve you well. So I know lots of people, pretty much as an advisor, and in the early part of my property investing, from 1998 to 2006, I was involved with brand new properties. But as soon as I knew better information, since 2006, I haven't helped or purchased myself personally a brand new investment property. So I guess there's a fair bit in that, and we've obviously put a little bit of salt on the wound there for you. But I guess as a question for the benefit of the community that we talk to here each week, hopefully you can overlay the principles that we're talking about. I certainly hope that you can get a positive outcome for you on this one, Alex. But it would start with doing a couple of those things that Ben mentioned before. For the rest of the listeners, episode number 8, investment stock versus investment grade, and episode number 37, understanding the scarcity factor, will further unpack what Ben and I have talked about on a headline level here. You notice our tone has also gone down a little bit because of the seriousness of the
serious
topic. Yeah,
it's deadly serious. I mean, this is the whole point. Property is a high value transaction, and so when we potentially see an underperforming asset, this is the reality that we have to deal with. So, again, another reason why we put this podcast together.
Yep. So hopefully that helps, Alex.
Terrific. Okay, next question comes in from Carol Jones. I've heard people talking about crowdfunding being the next property investment strategy. What is crowdfunding and how does it work?
Mate.
So, so we'll confess that we are not crowdfunding experts. It's not our specialty. It's not our discipline. But if I can give a general understanding of what I know, crowdfunding is obviously using social media and potentially the internet as a means to raise funds. From a property investment point of view, quickly back. So some people raise funds which are pure donations, and others pitch their business opportunity. So from that point of view, they're pitching that business opportunity, and there might be some commercial terms associated with that. But in purest essence, if it is a commercial idea, in other words, it's an investment idea, it's simply a joint venture. So, if people are sort of saying, I don't know person A over there, and I'm going to reach out to them and reach out to 10 others, and I've got this investment opportunity, or we should pool all of our money and buy a really good investment grade property. Well, that's effectively a joint venture. It's it's a buying scheme that they've created together. So you've got to be careful, because these people may not be qualified to give that type of advice or that type of recommendation.
Yeah, I was going to say, and I'm unbelievably unqualified to talk about this also, but if it's crowdfunding for a new mobile phone app, that's great, and bring everyone together, and you're all sort of trying to pioneer or take on the big guys. But as soon as you start talking about investment space, I think that's as soon as it starts to get popularity, that's going to gain a lot of interest from ASIC, I would have thought, and therefore you're going to have prospectuses if it's over 20 people.
You make a really good point. Both ASIC and the ATO are saying, because which jurisdiction does this lie in?
Yeah.
So, where is the money being stored? Where is it being collected? If it's overseas, what does that mean? One, for the security of the money that you're putting there, and two, does it mean that you're outside of our Corporations Act, where, property investment advice or what have you? So I think from that point of view, it really is just about setting up a joint venture or a buying group. And when you're doing such a thing, you just need to be very careful in terms of how you go about doing that.
Very good point, Ben. You continue to surprise me, given you're a Collingwood supporter, with what wisdom comes out of your mouth. So here we go. Another one from Rob. Rob is actually a friend of mine. Rob Costello. What property ownership structure should investors use when buying and owning an investment property? Individual, trust, company, etc. Is there a need to balance tax advantages with long-term asset protection on this issue? So Rob, quick one for you. Episode number 48, we did cover that off with Frank as a party in terms of getting into the nitty-gritty of the structures. But a couple of things. I always think that you need to balance how litigious the environment that you currently work in versus needing to asset protect. So doctors, lawyers, yes. Rob's actually a town planner. So whether or not he feels that he is in a litigious environment. So that's the balance between asset protection and whether you should put a structure in the mix.
Yeah, so this is absolutely a question you want to get answered by an investment savvy accountant, but you don't want to be sold into a scheme. You don't want to be sold into this whole concept of structures that are all about a tax saving scheme. At the end of the day, tax avoidance is illegal. Tax minimisation is not illegal. So I think from my point of view, if I was going to have a meeting with an accountant, I would want a good hour or two of them explaining all the different vehicles and the different structures in which I can look at that, and I'd ask them to relay those to my personal circumstances. We can only talk about what we know in our business as a statement of fact, and the vast majority of our clients are buying properties in their names, not necessarily in these structures, because yes, we do know several years ago certain structures had some tax benefits. Now, people were using those structures for asset protection, number one, but there were some tax benefits associated with those in terms of distributing incomes at lower tax rates. Some of those mechanisms have been corrected by the government, and so some of those tax effectiveness aren't in play anymore. So these are the other things too. We play by the investment rules set up by government, and when we're making advisory, when we're giving advice to clients, they're the game rules that we know. But just like our beloved game of AFL, every now and then they come in and want to tweak the rules, for the benefit of so-called the game. And in, take for example, a segue into negative gearing, the federal government want to tweak the rules because they want so-called fairness coming into the system. And I would argue with them that tweaking the rules has detrimental revenue effects in so many other areas that it's not a sensible thing to be playing with that, as an example.
Rob, the thing I always say to remember is property investment is a game of finance, not a game of bricks and mortar. So the first question I would ask whenever you're considering a structure outside of your own name, what are my lending options?
Right.
Because my lending options in my own name are quite vast, and then when I put a structure in, I want to know for my circumstances what happens if I put the lending structure in the mix, because you might be surprised at how small the pool of options becomes. Thanks, Rob. Say hi to Susie for me. Next one, Ben.
I've got Alistair Maxwell on Facebook. Hey, fellas, love the podcast and your book. Had an idea for content for you which could appeal to me and many others. In your book, you have case studies which are fantastic. However, I'm in between your dinks and your young couple examples. I spent my 20, and I'd love to read your book, Alistair, once you release it. I spent my 20s travelling around the world. How good is that? And having a good time. Now I'm in my mid-30s and I'm just starting to accumulate wealth, and we'll have some kids on the way soon. So my idea was for you guys to get a case study to interview. So in other words, get someone to come in that we can interview, or pre-record them on Skype, or even just have them written down and discuss different case studies. And I think that's where we will take the podcast in terms of starting to bring some of our clients in and talking about their journeys, as opposed to we're relaying their journey, so you'll hear it firsthand. So I think it's great, and it says keep up the good work.
So if there's anyone out there who's part of our community who would like to come and be interviewed about the principles before they started listening to the podcast and how they've applied them since listening to the podcast, reach out to Ivis, info@thepropertycouch.com.au, make it known to her, and she'll filter that through to us, Ben, and we'll definitely make that part of an upcoming podcast.
Yeah, and I mean, these are decisions that people are making in real life, and you know, if I was to sort of allude about your situation, you've got kids on the way, so that could potentially impact your cash flows.
Did you notice we're going in his 20s, he's travelling, we're going 30,
and, now
and then the kids, and we both went silent. We both got
yeah.
young kids, and we both went silent.
Yeah. So one of the things you want to look at is, in your particular strategy, it might be a strategy of cash flow. So we might have to chase higher yielding properties, or one high yielding property whilst you're moving through this intermittent income phase. That could be part of it. And you know, if you've got a really high income, we might be able to get a bit of growth, or a balanced asset as a balanced property. So that's something you'd consider. And this is where, again, I highlight the need to make sure that you model your cash flows out, and you put those lumps, you know, those intermittent cut-offs of maternity leave in there, because we would then be able to make some sensible decisions about that. And again, I think it's good for us to, during this year, to bring some clients in and talk about their journey.
Well, we've done some initiatives on the podcast. We've given some frameworks and principles. We're now reading out lots of questions from our community, so it just makes sense that the natural flow of that is to bring some people in and chat about it. What a great idea that was, Ben. So keep them coming. I got one from Cookie. She's actually a client of mine, Ben, and she's actually listened to the podcast. She's come and seen you for a plan.
She has.
She's now come and bought a cracking investment grade property here in Melbourne. So she's got listening
to the noise?
Well, I reckon she might be, mate.
Oh,
but Cookie is a delightful person.
She
Her
is,
husband Jimmy's got a tutoring business. There's lots going on for her. But here's a question. I have an economy finance related question. I would like to hear your discussion on it. As we step into 2017, the market has been flooded with negative sentiment news, and that's true.
Absolutely.
Lots of countries are under the water as oil and other commodity prices plummet. China's economy slowed down and share and currency tumbled. In the Middle East, you have ISIS terrorists, and European countries have migration crisis. The central federal government around the world responds to the crisis with more and more quantitative easing and money printing. I feel like 2008 all over again, and this time the crisis is on a global scale. I mean, Cookie, you have not held back. The question I want to raise here is, what will happen to the property market and banking policies if the crisis come in the near future? A few friends of mine are thinking that the property price will go down like the Great Depression. Am I best to wait until the crisis comes and then purchase undervalued asset? Kerry Packer would have done that. But if there is a crisis in the bank run, will interest rates rise and doing negative interest rate already? Is doing negative interest rate already? Will Australia be heading in this direction one day? How should I position myself now so I can prepare for the day to come? Thank you, Cookie.
Thanks, Cookie. We love your work. Okay, where do I start? I go global. Look, there are some headwinds in some markets. We do know that we have some debt issues over in Europe and the central bank, and we also know the United Kingdom are debating about staying in the EU. That's all okay. Like, the financial markets are currently working at the moment. The one that we need to worry about is China. Okay, so I'll put the glass half empty message out there first. So China is trying to transition from an exporting nation into a commodity internal spending society, and it's very important for their government to continue to bring people out of low socio-economic circumstances and poverty And that's what their agenda is. So the reason why, even though they're a communist country, their focus has been on trying to improve the living standards of the people there. And they've used what we would consider tactics that relate to an open and free market. Okay, so an open economy, and it's worked very well. Okay, so they're bringing a lot of people out of poverty. Now that said, they've also got issues with some of the wealthier people and sort of the middle class at the moment who are playing the stock market like it's a punting game. And they've also got property that's being built and valuations that are fluctuating incredibly. Like, as an example, Shanghai's property prices last year went up by 50%.
Oh,
so they tanked, and then they've come back because the word on the street is people are taking the money out of the markets, the equity markets, and now looking at bricks and mortar as their safety net. Mm-hmm. So, and one thing about the property market over there is they do have an enormous population. So, and they haven't got everyone into modern housing yet. So if there was Armageddon, we would see a significant turn down in the Australian economy because they are obviously our major trading partner. And that would have an impact where we would more than likely go into a recession for a period of time. But the possibility of that, if you listen to some of the people who research this, is a possibility of 10% at best. And the Chinese government have a lot of wealth and cash that they can stimulate the economy. And in fact, we only saw just early this week and at the start of last week a bit more stimulus coming back in. So they're aware of it. And economic growth and GDP numbers at around 6% is what they're striving, 7% what they're striving for. So the reality is if we take so now I'm going to put the glass half full. If we take the doomsday scenario out, which we obviously saw the 60-minute story, which was ridiculous at best in terms of taking a sample of a remote dust town in central Queensland and saying that that's reflective of the entire Australian property market is ridiculous.
It's not.
You don't know? So the reality is Australia does enjoy being positioned in the Asian century. So we're very well positioned for not only growth throughout China, but Indonesia and also India over the journey. So, and we can accommodate more people moving here. So we're going to see really strong migration into this, into our society, and we're transitioning from what was originally a manufacturing country. Now our wages are so high, we're a service country, and so having those new people arrive, and then them bringing their wealth here, and then buying goods and services, building new homes, and those type of things is a really positive story for us. So the likelihood, and there is a very finite likelihood that we might have a serious correction. But I've heard this since 2004, 2008 with Steve Keen coming out and saying property prices 40%. Are going to drop by 40%. Then he came out in 2012 and said it again. So my view is this: shelter is an essential, fundamental need. If we get shelter in locations that people want to live in, then the reality is values will stack up fairly well because it's an emotional asset that people are buying for owner-occupied purposes. So I don't lose 1 inch of sleep or 1 second of 1 inch of sleep.
1 inch of sleep. No,
1 second of sleep a night.
I speak Kingsley.
1 second of sleep a night worrying about that at all. If I felt that the world was actually heading down, because the US is also picking up as well. So if I felt that the world was moving in that direction, I'd be more cautious. But right now, I see the population forecast, I see the general economic forecast, I see service industries and a society that's going to be very well served. I see living standards being maintained, and I think we're very fortunate so long as the government continues to be sensible about structural reform and infrastructure, and still making our nation a very attractive nation for people to live in.
And Cookie, the thing to remember is these international experts have predicted 7 of the last 0 property crashes. Mate, that's a good strike rate.
Yeah,
that's
terrific.
A really good
They'll get
strike.
it right at some point, and they'll say, see. Look, there will be markets that will tank, but tanking is probably 20%, and they will more than likely be some high-rise stuff and some off-the-plan stuff if the economy is poor. But we saw, recently GDP numbers coming out that were really positive numbers. So, keep the sentiment strong, crew, because we also are responsible for our welfare and our society. So don't go into your shells, because if everyone did stop spending, well, we'll naturally cause our own. It'll be a self-fulfilling.
So, Cookie, at the end you said, how should I position myself? Keep doing what you're doing. You just bought an asset that's 7 k's from the Melbourne CBD. Bernard Salt, who we talked about a couple of weeks ago, said that it's a flight to lifestyle. So it's more important than ever to protect yourself by making sure you get the location right, because the Dubai effect that we talked about previously, where the wealthy people in China are parking their money in Australia, they're going to be parking it in the areas that you've just recently bought within the 10-kilometre radius of major capital cities in this country. Now, Ben, when you were on a podcast with Philip Tarrant recently, he said a number, I can't remember it off the top of my head, but it was around $6.8 trillion worth of value and $1.5 trillion worth of debt. That LVR across the country is remarkably good. Yeah. Our banking policies have non-recourse lending. It's stacked up through the GFC. So the question is, can it happen? Well, of course it can. But have we got foundations and principles in place within our banking system and within our government, and the fact we're politically stable and people want to come here for lifestyle and wealthy people want to park their money in this country? I think that the signs are positive, albeit that there's no guarantee.
Yep, never any guarantee. But if we go through life making decisions on potential what-ifs where the probability is so low, we won't create the wealth, and we'll look back on the past, and we will say that procrastination has killed our wealth potential. So you've got to say to yourself, are the fundamentals looking good? Yes, they are. Is society good? Are wage conditions good? Unemployment still holding, even though there is a little bit of spare capacity. So for me, the Reserve Bank still has some capacity to move monetary policy. So from that point of view, I'm quite comfortable, generally speaking, about what's happening. I'm not comfortable about certain values of certain areas in Australia, that being the outer suburbs of Sydney and some of the high-rise apartment valuations we're seeing. I'm not comfortable with those, but I'm comfortable in the particular granular locations and stock that I think are going to perform well.
Very good, very good. I think we can sneak in one quickly. Hi, this is from Chris and Sally. My brief buyer, 33 years old, married, 1 child, live in Sydney, work full-time, have 3 properties, 2 in Townsville, in brackets, both rented, building 1 in Melbourne currently. Currently renting in Sydney as units where we want to live, sell for 800 to $1 million. However, I can rent for $600 per week and invest. Well, there's your rent vesting article right there.
Investing.
We put all our money into our offset and pay out the credit card at the end of the statement period. Great principles.
Awesome.
We also have a full functioning pay-as-you-go withholding variation in place. These guys are smart.
Smart.
Question number 1. With the house I am building in Melbourne, will I ever be able to claim the GST I have paid in the building contract? And question number 2. With one of my properties in Townsville, I'm concerned that our body corporate fees are way too high. We pay over $5,000 for fees. No lift, no pool, and there's a 3-storey masonry construct building. How do I compare if this is the going rate in our market? Your advice would be greatly appreciated. Ben, as we round out towards 30 minutes, we might be able to quickly nail this one.
Yeah, look, this is an interesting one. I mean, credit where credit's due. Love the fact that you're doing you're getting your cash straight back into your offset account by doing your PAYG withholding variation. We might need to spend some time with Frank on that in a future podcast to explain to our listeners how that works. Basically, it puts money back in the account, so you get your tax return every paycheck, as opposed to waiting for the end of the financial year. The question I have here is, I'm interested to know why there's a GST amount on a build. I'm not aware of some of the GST costs in some construction parts if I'm buying off house and land, but that's a conversation that I need to have my own investigations on. In terms of answering the question, I don't believe you will be able to, but we're not tax experts.
No. So it'll form part of the cost base, but again, as Ben said, it's a tax question. And the second one is, with one of my properties in Townsville, the body corporates are high. So in Far North Queensland, we've bought stuff in Far North Queensland for clients. They have enormous insurance premiums, largely because it's a cyclone-prone area. So that is where the lion's share of the body corporate goes. And in fact, if you can look for efficiencies in that premium, you can clearly get efficiencies in the body corporate fees.
Yeah, I've got one in Cairns that I bought a couple of years ago, and the reality is the insurance premium is a joke. And so each year, our owners corporation, our body corp, basically shop the market. And we are starting to see some of those premiums come down, and they're significant. It was $32,000, and then I think we got it down to $24,000. So, and how do you go about doing that? Well, one, you reach out to your body corporate manager, the people who help you maintain the body corporate. There's professional companies who do that, and you ask them the question: what's everyone else paying? Do you know a good insurance broker in Townsville that can shop our business around so we can reduce those premiums? Because the reality is, and we also know that there's, especially in Queensland, there are some. The federal minister for Cairns, my understanding is, he is pushing for changes to how, because insurance is about spreading the risk to all people. So he's trying to say it's unfair that we carry the burden, and he's trying to reduce those premiums. So you're going to have to, there's some political pressure in trying to, make it easier and make it cheaper for not only investors, but also for, the 70% owner-occupiers who live in that area. So from that point of view, shop around and see if you can get those down, because that was what it will be. And if you've got big maintenance programs and those types of things, review everything. Review all your lines on your balance sheet and all on your expenditure, and just make sure that you're running a nice, clean ship, but you're also maintaining the asset well, that it's not deteriorating and then you have this big lump sum. So I still believe strongly in good sinking funds to help, in terms of any major repairs, but I'd also have a reasonable maintenance program, but just not an expensive one.
Very good. There we go. Hope that has helped you out, Chris and Sally. So Ben, I think we covered off some really good questions today. So we'd certainly like to encourage everyone to keep them coming in. Go to either info@thepropertycouch.com.au or just send a little note to Ivis on Facebook so that we can get those questions, and we will get to them as we go, Ben. So, mate, where are we going around the world?
Well, I've just picked up my little piece of paper and I've prepped. I picked it up last night,
Mate,
studied
this
it
is
for 4
live.
hours.
You can't tell everyone what our secrets are. You don't just pick up a piece of paper.
Yes, I do. Luxembourgish.
Luxembourgish.
Isn't
that little territory in between Switzerland and where you go?
No.
I think I remember going on my Kentucky tour and I need to get a stamp.
Yeah,
what's
I know
that
the one you're
little-
talking about.
Liechtenstein? No.
No.
That sounds like something you drink at Oktoberfest, isn't it?
Everyone who's probably listening to this, I know what it's called. I actually did that too. I went on a tour around there and went. It's got cheap banking. Remember, there's no taxes.
Yeah.
that
What
country.
is it?
Yeah.
Oh. Anyway, the listeners will be
Anyway,
going, you idiots, you should know.
Oh God, that is killing me.
Is it Liechtenstein?
I think it is Liechtenstein.
Is it Liechtenstein? Well, I went there anyway. I've got a stamp in my passport. That's all that matters.
Yeah.
You only went there for the stamp in the passport.
Probably right, something like that. Anyway,
After
from
a hangover.
Luxembourgish.
You want Kentucky?
This is the reason why I picked it, because I think I can get it.
Yeah.
I think I can get it. I think
The listeners know how it's going to go. It's going to be French. It's going to be to a 3-year-old.
It is going to be French, and it's awa.
Awa.
Yeah. So I didn't get it.
Yeah. There we go, folks. Luxembourgish.
Luxembourgish.
Until next week, awa. See you, folks.